Hi there, you're tuned into Closing Trades on ET now, and you are getting us live from the Motilal Oswal studios and talking about the markets. Then it's been quite a volatile session, but a lot of result reaction is what we are witnessing. Case in point being the latest SBI, which come out with a decent set of numbers. The asset quality was quite stable. The slippage number were actually down, and look at the move in the stock after the earnings. The stock did try to recover in just a while back. The stock was also holding on to the green territory, but now once again in the red with a cut of almost 1%. The other stock in focus is Trent, which is now down 6% because it was almost an inline set of numbers, but not much excitement there. It's a 6% cut coming in on that particular stock. But other than that, Cheryl, on the index level, it's the weakness that we are seeing trickling in.
Absolutely, Shrishti. We've actually seen some sort of a weakness creep into the markets, 0.5% downtick coming in for the benchmark indices at the day's lowest point. SBI just reacting to its numbers at this point in time. We did see some sort of a recovery in the counter, but yes, could not hold on to those levels. Advanced decline ratio, if you look at it over the last 1 hour or so, has actually declined, actually has worsened. Now you have the advanced decline ratio favoring more of declines at this point in time. But Nikunj, it has been all about earnings, at least for today, because you had SBI that's come out as numbers. You had Trent also a short while ago that has come out with these numbers. And we are waiting for 4 more Nifty companies.
We are talking logic today and not theory, which is Trump, dollar index. So today markets are reacting to micro rather than macro. And that's always a good market to have when you have markets which are, in a sense, governed by logic, governed by news, governed by earnings, governed by, and not governed by sentiment, hope, assumptions, right or wrong. I don't know, but when markets get into this tailspin of they start reacting to every bit of macro thing which is happening in the world, it is not a good sign. But SBI numbers, I don't think there is anything wrong with those numbers. Stock will settle down. Similarly, Trent, expensive, nothing wrong with the numbers. So SBI numbers are not great, but stock is cheap. Trend numbers are fantastic, but stock is expensive, to put it very simply. So Sunil Kaul, global emerging market equity strategist with Goldman Sachs, joins us now. Good to have you back. Thank you for joining us. How are things with you?
Things are great, Nikunj. Hi, how are you? Good to be back.
But when are FIs coming back?
I think you want the global sentiment to improve a little bit before FIs can come back. As you started the show, I think today my market is trading micro as opposed to global macro. So let the global macro stabilize a little bit.
The government has decided to do what a year ago was unthinkable: a tax cut and giving money in the hand of taxpayers. I never thought I would ever write this headline after a budget. The headlines which I've written after 20 years, yeah, tax increase, surcharge going up, but it's the other way around. 1 lakh crore comes back into the economy. What kind of multiplier it could create?
Yeah, I think to think about that, Nikunj, it's important to think where could this money flow through, right? I think you're right in pointing out that you're putting like 30 basis points of GDP or basically 1 lakh crore in the hands of people. We think that money sort of gets divided or allocated to 2-3 things, right? So there will be some part of that would basically go into urban deleveraging. I think people who have been sort of under stress, kind of borrowed in terms of personal loans, credit cards. I think there will be definitely some consumer deleveraging which will happen, which in turn should benefit some of these consumer retail-oriented lenders, right? Another, I think, pocket could be, I think, the high-end part of the of the consumption spectrum, the people who are earning more than 25 lakhs, let's say that. I think that will probably end up getting saved. I think it's the urban consumption where we think, let's say 13 million people in terms of tax filers, but there will be some dependents, some kids, let's call it like 30 million people who are sort of getting a tax relief in here. I mean, we sort of think that 60 million is roughly the affluent consumption sort of basket in India. So you're seeing the bottom half of that 60 million, the 30 million, which are not sort of poor, but still kind of somewhat affluent, which have been sort of consuming this on discretionary consumption.
Oops, lost him there. Never mind. What do we have on the markets? Mindacop numbers, its auto ancillary numbers are at 65 crores versus 52, up 23% year on year. And you can see Mr. CS Shetty also, and he's the new chairman of State Bank of India. We'll be cutting across to that press briefing in perhaps a minute or so. But is Sunil back? I would give it a chance to see if the Goldman Sachs guest is back. SBI, we can of course cut in.
Global economy is being driven by a strong US economy, offsetting the weak euro area and China. As per the latest assessment, the IMF projects global growth at 3.3% both in 2025 and 2026, below the historical average of 3.7%. The global inflation has continued to soften and is expected to approach inflation targets for most of the central banks, albeit with a different speed across geographies. However, on the downside, the impact of trade wars on global growth and in turn on inflation remains uncertain at this stage. While the new US administration...
Okay, Sunil, we just lost you there. We want to perhaps, or you may want to take that point forward. 1 lakh crore comes back into the economy. How will that be spent?
Yes, so just very quickly, Nikunj, what I was saying is that I think part of that will sort of go into this consumer deleveraging, right? People have kind of taken credit card loans, personal loans. I think some of that will be spent there, and that should help some of the consumer retail-oriented lenders. I think part of it definitely is going into sort of discretionary consumption boost, kind of travel, so other discretionary categories, fashion, retail. And some of it will also sort of go into savings, especially I think with people with more than 25 lakh, which is probably the higher end of the consumption cohort, that will end up spending a little bit. So I think this entire 1 trillion INR, it probably doesn't, entire part of this doesn't boost consumption as it is, but it probably sort of gets divided into some of these pockets, as I mentioned.
Came out, the theme was don't buy Build India stocks, which is Capex, infra, defense, railways. Move to consume India stocks. Is there merit in thinking like that?
I mean, I think there is some merit to that, Nikunj, because I think if you just looked at, I mean, obviously from the budget, it's very clear that your allocations to large capex spending is roughly sort of flat as a percentage of GDP, right? Even I think allocations to roads and railways is almost sort of flat. Defense is a little bit 5% or so. And there is a consumption boost that we talked about. But I think if you just looked at the portfolios, right, over the last sort of 3-4 years, I mean, defense as a case in point, railways as a case in point. I mean, our sort of baskets or portfolios in those areas have run up like 300-400% in the last 3 to 4 years, right? And so I think what needs to happen is people will reorient some of their portfolios away from some of the very capex sensitive sectors more towards discretionary consumption categories, and that's how we are kind of set up in our allocations as well.
Now let's look at the numbers in totality. Capex is still expected to grow in 10%. I mean, it is in line with India's nominal GDP in and around plus minus 1%. Consumption will not grow at 10%. So if the Capex growth is higher than consumption growth, I wonder why everybody is talking about buying consumption stocks.
Yeah, so again, I think you have to look at it this way, Nikunj. I think within the 10% capex growth, which is obviously revised estimate on budget versus the estimate there, there's obviously flat allocations to some of the pockets. Railways is a case in point. I think highways is a case in point. Whereas I think there is slight, I mean, defense is also very moderate allocations. Whereas I think where allocations have gone into is money has been sort of given more towards states for doing sort of infrastructure plans. And I take your point because there will be some sequential improvement in capex given the underspend that has happened this fiscal year, right? So I think from a sequential perspective, you might see some spending coming back. But I think the broad point, and this is something we have been sort of saying for a while, is that gone are those days wherein you actually saw 30% plus capex spending during the last 3-4 years, and then the capex spending going forward will be more in line with nominal GDP, which is what we have been seeing in the last couple of years, sort of 10-11% in that sense. But if you look at how the portfolios have performed, you have seen significant outperformance, as I was saying, in some of those capex sensitive cohorts, whereas consumption as a category has lacked. So we do think that on a relative basis, at a very aggregate level, you would see some outperformance from the consumption cohorts compared to compared to the Capex sensitive sectors. Again, within consumption, it's a broad category. We don't think, as we discussed, staples benefit a lot from that. But some of the discretionary consumption categories, I think QSR is a good example in point that could do well. I think there is a lot of focus on tourism, travel. I think that would continue to do well. I think footwear and some of the other discretionary categories, durables for that matter, also we think could benefit. So again, I think there are very pockets of consumption, discretionary consumption categories that could relatively do better compared to the very heavy sort of capex, government capex intensive sectors that have done already well in the last many years. Obviously, they have pulled back over the last sort of 3 to 6 months, but compared to how much rally they had in the last 3-4 years, we think there is still chance for that reversion to happen, where consumption as a category will do better than infrastructure.
Divided on what is the right way to approach consumer staples. Can they get re-rated after budget?
Look, I think again, maybe we sort of missed it at the earlier in terms of when we were talking about how will this money get spent in. So if you look at the tax relief that's been given, that's given to roughly sort of 13 million consumers in terms of the relief there. If you add in the dependents and add in the kids in there, this is roughly, let's say, 30 million cohort. In our earlier work, we have sort of classified affluent India as the 60 million cohort, which is something that's been sort of driving a lot of the consumption in India. So what's happening is that within that 60 million, you're probably seeing the bottom half, the 30 million, where you are giving the tax relief. That's not sort of poor consumer, so to speak. It's still somewhat affluent consumer, and they have been sort of consuming the discretionary categories. We think they will continue to consume, right? So there is not as much tax relief directly to the staples, but I think it's more in the sort of mass urban urban consumption where it is coming in from. For staples in particular, we do think, as we know, in the last couple of quarters, they've already seen volume growth improving. So I think we are seeing a gradual recovery in in rural consumption in general, and that should help staples. But the recovery would be very gradual. I think we already have had a decent sowing season, barring any kind of weather shocks. We might have a decent harvest as well. So all of that should incrementally be good for rural incomes. But from a budgetary standpoint, there is not a lot of support in that, and we think there is a gradual recovery in rural, which will continue to mean that staples should their volume growth should improve, and you could also see a little bit of pricing power come back, and so the profitability probably gets to kind of 10% earnings growth or so for the staples as a category. But does that necessarily mean that they outperform within the broader market? We think discretionary probably is a better bet than staples.
Within Capex, there are companies which are dependent on private sector Capex. There are companies which are dependent on government sector Capex. And if data is to be looked at, private sector Capex has not reached satisfactory levels. Government is doing all the heavy lifting. So is one better off buying into Capex themes which benefit from government? Could it be defense? Could it be railways? Could it be simply roads?
Yeah, I mean, as I said, I think within the broader sort of Capex sectors, Nikunj, so we have been underweight cement, where we think, I think you still have sort of challenges in terms of competitive intensity, but also kind of some pricing pressure. So cement is something we have been underweight. I think infrastructure, within infrastructure, where we are kind of more neutral, we have pockets of the broader industrials, airlines as a case in point, I think, which could do well. But I think sectors like infrastructure are very capex heavy, railways, roads. I think they can underperform in the current context. Is our sense. So we're kind of more cautious those segments.
It up with one final question, which is that what to your mind are the deserving P multiples for consumer stocks, given that we are growing at 6.5 to 7%, and what is the deserving P multiple for Capex stocks, considering that these businesses will not grow above 15-17% irrespective of the cycle?
Yeah, I mean, that's a great question, Nikunj. Look, I think historically there has always been kind of premium valuations to Indian consumer stocks. I mean, compared to anywhere else in the EM, and at the peak, and many of these consumer stocks, you can't sort of broadly overgeneralize, but they were sort of trading at 50, 60, 70 times PE. Market itself at the peak in September, before we just downgraded it in October, was trading at 25 times the aggregate market. From there, I think we have seen a decent pullback in the market, close to 15% plus. But when you look across categories, including in consumption, you're seeing sort of 20% plus multiple deratings in in many of these stocks. So our sense is that you're getting to a level in aggregate terms where market is getting sort of more fairly valued. I mean, within that, I mean, for the headline market overall, we've sort of gone from 25 to 22 times PE, and our sort of fair value target is more like 21. But you have seen derating across categories, barring obviously financials, which were already cheaper, and IT. And so consumption has also seen 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 a derating. And so I think in that context, we think the multiples are currently sort of more slightly above average, but not sort of super expensive. I think till India remains a broader consumption story, you still have consumption trading relatively sort of more expensive than the rest of the market. Because, I mean, and when you talk about Indian consumption, this is not just kind of staple stocks, but you have sort of discretionary categories, you have the paint stocks, you have the consumers facing banks. That's all the broader consumption. And barring IT, a lot of the other India, a lot of FI is still kind of engaged in the consumption story in India, and so it still will trade a relatively higher multiple to the rest of the indices and rest of the consumer pack across the EM. So somewhere around sort of 30-40 times P is still relatively okay compared to the broader market trading at 20 times.
Let's really appreciate your time, and so glad you could join us. We take a break.
Hi there, you're watching Closing Trades right here on ET Now, and we are joining you live from Motilal Oswal studio. Let's take a look at what the markets are doing at this point in time, given the fact 0.5% downtick coming in for the benchmark indices. You have SBI that's reacting to its numbers. You have the management that is speaking in the press conference right now and talking about the growth going ahead, where they're saying they're maintaining FY25 credit growth guidance of about 14 to 16%. The management's also saying that they will come to a double-digit growth in unsecured personal credit area as well. So that is SBI for you, 1.5% downtick at this point in time. But let's bring on board Kunal Bothra as well as Naresh Marani to understand more about the markets. A very good afternoon to you, Kunal, as well as Naresh. Thank you so much for joining us. And Kunal, what exactly happened to the markets today?
I think difficult to fathom, but you know, it's been more sideways. So after a 1,000-point rally, we can just probably try and attribute that maybe this could be a mild bit of profit booking. I think the case for the markets today was that the stock specific selling was a little more reminiscent of what was seen in the last 2-3 months, where you'd seen some intraday knee-jerk price actions for stocks, where you saw sharp selling. But this time around, I think the damage seems to be contained to a larger extent, from the individual stocks perspective, because you see many of the stocks, even after intraday fall, they have that capacity to come back into a correct, into a bounce back mode. That was something which was missing over the last many months. And that, I think, in a nutshell indicates that we are still, trading into a bit of a positive bias. Yes, over the last few days, we've seen a 1,000-point recovery. That's probably helped the base for the index to move up higher. So from a 22,800 mark, we are looking at a formidable support now at 23,500 levels.
All right, that's the take coming in on benchmark indices. But in today's trading session, what we see is that Pharma as a pack is holding up quite well. It's Cipla that is leading it from the front. And other than that, some of these other IT names are also bucking up the trend. Stocks like Infosys as well as Wipro, even Tech Mahindra are up in today's trading session. But what's not doing well definitely is the stock of Trend after a very disappointing, not a disappointing set, but rather some of the internals don't look that great. Case in point being the LFL growth for the company, which is now in single digits versus a double digit growth is what we have seen in the past. And the stock is now at the day's lowest point, 7% cut coming in on this one. But Naresh, if you can help us with your take on Trend, because it's now close to 5,300 levels. Next support.
So the next price point for this stock comes around 4,800 to 5,000. This is where it had a little bit of a cluster back in May, June of last year. Out there, we could see some support, but overall, the longer term trend has now turned to weak. The last 1 year lows are also about to break. So the view is it could go and consolidate around 4,800 to 5,400 going forward.
That's the take coming in on Trent, but second straight day on the trot wherein we are seeing Titan as well, that is now down about 2.5%. But just ahead of the earnings, we are also seeing weakness trickling in on Bharti Airtel, a 2.5% cut coming in on this one. But Kunal, help us with an understanding of what kind of a positioning we are in, we are seeing happening on Bharti Airtel.
Well, it's been absolutely sideways now. Last 2 months, specifically the entire month of December and the month of January, the stock was stuck into a band of 1560, 1570 as a support and 1650 broadly as a resistance. So, and even currently the stock is exactly at the midpoint of this 70-80 point band, closer to that 1625 mark as a pivot range. So, I believe that even if there is any kind of a positive or negative reaction, the stock would just come back into retesting the resistances or the support respectively. So, I don't see any major churn of events for Bharti Airtel. I would just expect that the stock would gradually consolidate, and this has been one stock which has completely been different in terms of price trends over the last 3-4 years. I remember a point when Bharti Airtel was just about that I think 445, 450, 500 kind of a zone where it was stuck in a band for a couple of years. But post that, when we saw the stock moving up higher, it's been a completely different trending stock, a very slow, gradual but a consistent price trend. And this time around, what you're seeing is a more of a broad-based consolidation of Bharti Airtel. The chart patterns are very strong on the longer-term basis, short-term wise consolidative.
Right, let's take a look at some other counters also who've come out with their earnings today. You had MRF where their PAT actually declined sharpest in about 11 quarters. This on back of high input costs. The stock is down right now. It's recovered from the day's lowest point. You have Chambal Fertilizers that had come out with their numbers earlier on in the day. You have Prism Johnson also that has come out with their numbers. NMDC is the other one where you had the PAT that saw an uptick of about 30% on a year-on-year basis. Sales saw an uptick of about 21%. But yes, not that much of a great move coming in most of these counters, like the way how Trent is moving on back of his numbers. Jinay is here to exactly tell us what went wrong with Trent in the quarter gone by. Jinay?
Well, yes, currently Trent is trading under pressure. If you look at the overall numbers versus the consensus estimate, there is a slight miss. If you look at the revenues, the estimated numbers was the growth for 40%, but what company reported was around 37%. However, there was a big miss on PAT front. The expected numbers growth were 51% year-on-year basis. However, the growth was just 36% year-on-year basis. Operationally as well, there was a slight pressure on EBITDA margins. Now, apart from that, if you look at the fashion portfolio, the fashion performance, the like-for-like growth that was earlier growing at double digits, and that has now come down to a high single-digit growth. Apart from that, store, which Star business, which company has told that will be its upcoming growth driver for the company. If you look at the overall stores, that remained at the same level of 74 stores in Q3 versus Q2 as well. Apart from this, if you look at the overall valuations of Trent, it also remains at elevated levels of forward PE of 82 times, and that is why we are seeing some pressure on the company.
All right. Thank you so much, Jinay, for highlighting what's definitely not boding well for Trent. It's a 7% cut is what we are seeing on that particular stock, now down about 8.5%. But with this, let's move on. Let's get you the BTST ideas from both of our experts then, and let's understand that which stocks are they tracking at this point in time. Kunal, you go first. Tell us which is the stock making to your list.
Well, in terms of the BTST trade, I'll suggest 2 buy calls. The first one is about Wipro. That's a chart which is looking extremely attractive. The stock perched a fresh breakout of 310, 320 range. Would look out for targets in the range of 340, stop loss at 308. And the second is about IEX, a stock which has given a very big breakout about that 175, 78 mark. So keeping 175 as a stop loss, would look out for targets in the range of 200 at least.
All right, so that's the BTST idea coming in from Kunal. Naresh, what about you?
So first is the buy on Metropolis Healthcare. The stock has made almost a double bottom and seeing a recovery. Expecting it to continue for the next couple of sessions. Stop loss at 1830, target price of 1900. Second is a buy on Adani Ports. The stock has made a good pace and now last 2 sessions there has been good momentum. Expecting it to continue. Stop loss at 1145, target price of 1200.
All right, so Adani Ports as well as Metropolis is something that Naresh is liking at this point in time. But with this, viewers, it's once again time to slip into a very short break. Don't go anywhere. We'll be right back. Welcome back. You're seeing us live right from the Motilal Oswal studios and taking a look at the markets because it's Nifty Bank that is now once again in the green territory, holding on to the gains of 43 points right now, while Nifty 50 has once again scaled past to that 23,600 mark as well. So we are seeing some bit of recovery from the day's lowest point at the index level indeed, but definitely stocks like Trent, Bharti Airtel, Titan are seen to be a bit under pressure, while SPI as well posts the decent set of earnings is now down about close to 2%. But for this, let's also welcome Mayuresh Joshi, who is joining us on the show right now. Hi Mayuresh, good afternoon and thank you so much for your time. Mayuresh, I've been wanting to talk to you regarding the chemical space because of late the kind of discussions or kind of reports that we have highlighting that the heightened tariff on China, there could be some opportunities for select chemical players to benefit on, and even today we are seeing stocks like Aarti Industries and so holding on to decent gains. But Mayuresh, anything incremental or anything substantial to look out for within the chemical space? How are you reading this announcement related to tariff?
Afternoon, Srishti. I think two things. One, I think the China plus one policy is working into earnest on all counts. A lot of managements across the European zone or across the globe are wanting to diversify their supply.
Snap that line with Mayuresh. We'll try to get him back and have his take on some of these chemical plays, because of late we are seeing some of the chemical counters, be it Tata Chemical, Aarti Industries, Navin Fluorine, PI Industries, they are doing pretty well. But Mayuresh, believe that you are back with us. Please go on.
Sure. So I think China plus one is where I was finishing my point, where a lot of the corporates in Europe or rest of the globe are probably looking at. The second aspect obviously is with added tariffs coming through on China. I think that does incentivize the industry ex-China. And therefore, I think a lot of our players who have been putting capacities as far as backward integration is to be believed, is something that can work in favor as far as earnings are concerned. The second aspect in terms of diversifying their supply chain as well is something that will positively work out the numbers as well. Now, two, three aspects. One, I think the commodity-driven chemical companies are still going to feel the brunt because China is still expected to down significantly. You've seen that probably in terms of both the supply aspects as well as demand coming off. Take the instance of Tata Chemicals as an example, where soda ash demand and pricing were both lower. On the other hand, if you're probably looking at certain specialty players where there are niche capabilities that are involved, something like an Amy Organics as an example, has done exceptionally well. Obviously, valuations are a tad bit expensive, but the EPS RS rating look fine. So I think the expectation in terms of earnings trajectory and management commentary seem to be in place. What the budget has also announced, Srishti, in terms of batteries, input of a lot of critical materials in terms of ensuring that the production of lithium-ion batteries happens in real estate and good pace as well. Neogen Chemicals, who are expanding the electrolyte and electrolyte salts business. I think this can be one stock that can be kept on radar as well. I think very strong EPS ratings as we see it. And again, I think the entire pack, the entire refrigeration pack, as I would call it, whether it's Navin Fluorine or SRF to a large extent, have largely delivered on numbers. And second half is exceptionally good for these companies as well. So I think the expectation largely in terms of decent volume growth, pricing remaining in favor, and therefore earnings probably remaining steady state in the second half seems to be a case. Again, select agrochemical companies outside the basket might continue doing well. We've seen a good monsoon. We've seen a good Rabi harvest. There are La Nina conditions evolving, which means the coming monsoon will also be equally good if reports are to be believed. And that stands in good stead for a few agrochemical companies as well. So yeah, I think chemical as a space probably looks well poised to deliver in 2025.
Right, so that's all about the chemical space. Then actually, let me take the leaf out of your conversation, Mayuresh, and come to Kunal and ask him. In the chemical basket, Kunal, we've seen that these counters have not actually performed well over the last 3 years or so, right? Given the fact that after the China plus one strategy played out, you saw these companies actually go into a lull mode. Now, do you think merits a relook, given the fact that maybe fundamentally there is a trigger, but on the charts, what's your view?
Yeah, on the charts also we are seeing some positive activity building up, and that that was something which was missing for the entire specialty chemical space for past many quarters, many months. And I think that's what is the biggest change which has happened. For example, names like Aarti Industries, a stock which has fallen from I think 750 levels to sub 400 or just 400 thereabouts in the recent past. I think that stock has managed to make a very good comeback. We've seen classical patterns. So in terms of price patterns, we've seen a very strong formation of an inverted head and shoulder pattern for Aarti Industries, and the stock has confirmed a breakout of that. The volume activity has increased substantially for the stock in the last 2-3 weeks or so from the base of this 400 levels for the stock. And then try and compare with the other names, the likes of SRF, for example. That stock has done exceptionally well. You've seen Navin Fluorine also pick up extremely strong pace. The stock has recovered almost like V-shaped trajectory in the last 2-3 weeks. Now, when you see such kind of a price action, it just gives an indication that when stronger stocks become all the more stronger, and when they go back into a V-shaped recovery and come back into a trending or a leadership mode, it's time that the underperforming stocks, they would also make a comeback eventually. The only case in point of the concern in terms of the stock is Tata Chemicals, because that's a stock which has dragged significantly, and we've seen many a times that the stock has gone through a revival uptrend, but then that gets immediately met with a lot of resistance or some kind of negative news flow. So that's the only concern in terms of the specialty chemicals chart, but most of the other names are looking fairly attractive.
All right, so that's about the chemicals space. Definitely watch out for that one very closely. You had Mayuresh give you the rationale for the fundamentals as well, but let's watch out for also the auto pack, because a lot of numbers are slated to come out today. You will have Hero MotoCorp, I believe post-market as, yes, it will be post-market as, isn't it, Shrishti? One is Hero MotoCorp, and tomorrow you have M&M. So what are we penciling in for these companies?
So yes, definitely. For Hero MotoCorp share, there's not much expectation because the volumes have been quite a drag, and this time we are just hoping that the margins are quite stable at 14% is what we are expecting. So all eyes on that. Definitely the management commentary is something to watch out for, because on their long-term margin guidance, they still maintain that 14 to 16% range. Let's see that how the company delivers this time around, as well as going ahead, what are the new product launches that are planned. But talking about M&M, there we can see a bit of a excitement trickling in, because this time we are expecting a good set of numbers. Why so? Because their tractor as well as automotive division volumes have done pretty well for themselves, although on the margin front there could be some bit of a drag on a sequential basis for their auto EBITDA margin because of the higher promotional spends, the heightened discounts that we have seen in Q3. But on the flip side, the tractor volumes were also quite supportive, so that should actually support the overall numbers, and this time on a consolidated basis 14.5% is what we are expecting. In terms of the profit figure, 3,189 crores is our expectation, but don't get into the sequential degrowth that is likely. That's a 17% cut, because there is reason to that. The profit is expected to decline sequentially on the back of higher dividend what the company registered in Q2 of FY25, as well as this time there could be some dividends from coming in from TechM, but on and on, 3,189 is the number that we are working with. But definitely on the management commentary, how do they see the outlook for the tractor industry overall? Is there any changes to their guidance? The industry-wide guidance that they give is something that we'll be watching out for. And definitely 14th February is the EV booking that the company will open. So the initial booking number, the sense on the street, what they're getting is something that we will be watching out for.
So that is about M&M, what we should watch out for. But Mayuresh, let me come to you, and how can I not ask you this question, given the fact that post-budget you have the entire consumption theme abuzz. Everyone's talking about consumption theme, and now they're talking about consumer discretionary versus consumer staples. You're also in the same camp, that who is more tilted to a consumer discretionary at this point in time?
Possibly, yes. And I think the results will start flowing in as we head into the first half of the next financial year, because that is when I think the actual effects will start taking place in terms of discretionary spending coming through. But again, I think clearly, if you probably look at the entire consumption basket, which is pretty wide, if you probably look across the value chain, you're probably going to see a few FMCG companies do well. You're going to see some auto companies do well as well, specifically two-wheelers, case in point. M&M is something that we continue holding as a clear disclaimer in our global portfolios as well as four-wheelers are concerned. But generally, I think discretionary stocks should start doing well. Let me also toss in a few QSR players out here. They've really underperformed in terms of their SSS growth over the last few quarters. It's been a drag as consumption was going down significantly specifically in urban areas and tier 1, tier 2 cities as well. But again, I think with expectations of more spending expected to come through, there is a huge possibility that the underperformance that these QSR players have probably delivered might actually do well. So Jubilant was a stark outperformer compared to the rest of the pack. And relatively, its ratings and rankings as we see it in markets with India have held up so far so good. So I think if there is some turn of events, I think a few of these subsectors within the conventional basket should do well.
All right, that's the take coming in on some of these FMCG plays. But talking of one such stock wherein the numbers just came a couple of days back, that is Castrol India. If we can bring that chart on an intraday basis, what a move. It's almost an 8 to 9% jump what we are seeing. And exactly from those 200 levels, the stock tried to take a support and even now inching to 211 odd levels. It's at the day's highest point. Kunal, any take on this one? Because the stock has corrected significantly from those higher levels.
Yeah, I remember I've been tracking the stock, for quite some time. I think over the last 2-3 quarters, the stock had gone through initially a very strong bout of a rally from I think 100 levels or 150 levels is where the rally started off for Castrol in 2023. The stock moved towards 280 or 285 thereabouts, and from there I think this leg of correction that come back to that 165 mode, which means that we could now be looking at a point where the stock has formed a formidable base. Now the best part about the chart today is the volumes. The volumes today on the daily time frame are exceeding the volumes in the last 2 days, and the last 2 days itself, the average volumes was almost 7 to 8 times the volumes over the past many days for the stock, which means it's not just a strong based buying in the last 2 days, but more of an additional buying which has happened for Castrol today, and that too complemented with the price moving up towards a multi-week high of 210 plus. I believe that this could be a very strong sign of a revival. Now, typically what happens is after such kind of a strong volume formation, the stock eventually gets into a first leg of consolidation. But then, after a few weeks or so, the stock picks up pace and then moves up another 10 to 15%. So my sense is that over the next 3 to 4 weeks, we could be looking at a potential 240 to 250 kind of a target range for Castrol.
All right, so that's about Castrol's third consecutive session of up move coming in for that particular counter. Naresh, coming to you, I wanted to get your sense on the IT pack, because now you have a sense coming in the market that this year you could have the banks as well as IT outperform the benchmark indices. What's your take on that? Are you seeing that already transpire on the charts?
So for now, it looks like a consolidation. We've not seen a sharp correction as such in the sector as such. Post the numbers also, the stocks have consolidated. But if you look at the longer term structure, looks interesting. So going on with, say, a Tech Mahindra or an Infosys, both these names or even a TCS is around the 2021 highs and consolidating around that area. Eventually, they could break out over the next 6-12 months. So for now, it looks like at least for the next few weeks, it would consolidate, but the longer term structure is still positive.
All right, that's the take coming in on Tech Mahindra. But looking at the markets right now, 72 odd points on the positive territory when it comes to Nifty Bank, while Nifty 50 is trying to recover a bit from the day's lowest point. But a lot of these pharma counters are doing pretty well for themselves today. Definitely the large caps are making to the list in the Nifty 50 gainers. But in the broader market space, stocks like GSK Pharma, what I see is Eris Life Sciences. Other than that, Abort India, these stocks are holding to strong gains right now. But one such stock, that is GSK Pharma, that is now up around 17 odd percent. And Kunal, quickly, if I can have your take on this one, it's a sharp spike coming in on this particular stock. We don't discuss much about this, but anything onto the volume front that you are spotting?
Yeah, exceptionally strong volumes. I think 24 lakhs in terms of the NSE volumes for Glaxo on the cash segment, and that exceeds the volumes for Glaxo, I think over the last 1.5 odd year for the stock. So that itself tries to indicate that this is a very strong volume push the stock has shown today. And I've been tracking the stock over the last 1.5 odd year. I remember, I think 2024, the stock had moved from 1500 levels to I think around 2800 or 3000 plus mark. And post that, the stock has gone through a correction. So this could actually be a good advantage for traders with a longer term time frame to try and maybe accumulate or add more quantity at current levels. After this volume kind of an up move for Glaxo, this could indicate that the stock has come out of a major consolidation as well as a price correction.
All right, that's about GSK Pharma. Let's take a look at ITC because right after market close on around those level times, you'll actually have ITC report its quarterly numbers of the last 15 minutes or so. You've seen a spike in the counter from the day's lowest point. Let me bring up what Snehi to exactly understand what I'll be penciling in for ITC.
Well, yes, overall we're expecting a rather decent set of numbers from ITC. Nothing great is expected this time around because if you take a look at the standalone revenue, that's expected to come in at 18,456 crores compared to 16,483 crores, which is an uptick of 12% on a year-on-year basis. EBITDA is expected to go up by 6.5% at 6,402 crores. Net profit, however, we're penciling in some pressure over here, down 5% on a year-on-year basis. We're seeing this figure at 5,290 crores compared to 5,572 crores on a year-on-year basis. On the back of this, margins are also expected to contract slightly at 34.7% compared to 36.5% this time last year. Some key expectations: the cigarette business volume is expected to grow anywhere between 3.5% to 5%, and sales growth of 7% year-on-year is expected in cigarettes. The FMCG business is expected to grow by 5%. Now, margin pressure is likely to persist due to inflation in leaf tobacco and agri commodities and high growth in agriculture business, which is also a low margin business. The paper segment is expected to remain weak and expect muted performance here. Just an uptick of 2% on a year-on-year basis in terms of sales revenue, rather, is what we're expecting in terms of the paper business. Agriculture segment and hotels are expected to do well this time around. What to watch out for when the numbers come out: demand outlook on rural versus urban, the competitive intensity, companies' outlook on raw material trends, the agri-business outlook, as well as the pricing strategy are going to be key to watch out for. But well, yes, overall, we're not expecting any surprises, but well, yes, a rather decent set of numbers from ITC this time around.
All right, thank you so much for that, Snehi, for talking about ITC to all of us. But Mayuresh, let me come to you and get your actually comments coming in on Swiggy versus Zomato, given the fact that these two have come out with the numbers, and with the Swiggy's numbers coming out, actually Zomato's numbers look much better. What's your take on both of these players?
Blinkit has done relatively better compared to what Instamart GOV has been. And therefore, I think if you probably look at the construct again, right, Zomato is expected to open 2,000 odd stores by the end of 26. They are preponing that by almost a year, which means a large part of their cash pool, almost 19,000 crores, is going to get deployed in terms of opening these stores. Now, if you look at the cohorts in terms of the fresh opening of stores that probably happens, with the fresh stores, the contribution margin are negative 8 or 9%, and that might continue with the aggressive mode that they'll be following in this financial year as well, which means that the overall cash flows will be a drag. Obviously, you'd seen some element of improvement that had happened, and a significant one at that, as far as the quick commerce operations were concerned. Food delivery is still decent, if I may call it, but there are a lot of innovations happening even at Swiggy's end as far as food delivery is concerned. And therefore, I think with Swiggy also probably getting into the race to probably open up more stores at an accelerated pace, the cash flow hit is going to be very, very evident on balance sheet. So I think the earlier targets that were probably set out get delayed and deferred by at least a few quarters. And that does not augur well in terms of the bottom line expectations that the street probably puts out. Obviously, I think 27, 28, with all these expansions coming through for both Zomato and Swiggy, might be a different ball game altogether. How their competitor in the unlisted space, Zepto, probably reacts is going to be very, very interesting as well. But they are also on a cash burn model. So somewhere I think the cash flows might be negative for a lot of these stocks, including Zomato, Swiggy. And therefore, I think there will be some element of pain coming through as far as prices are concerned as well. So I think staying away at least from these counters, at least at this juncture.
Staying away for at this point in time. That's the advice coming in from Mayuresh. But with this, Mayuresh, Kunal and Naresh would like to thank you for taking the time out and speaking with us. But with this, let me hand over to Snehi then, who's joining us to give us a sense that how was the trading session so far today. Snehi.
Well, absolutely, Shrishti. Well, started off to be a decent session, has not ended up to be a decent session today because 23,620, we're even further below the 23,650 mark. It's a big cut coming in on the Nifty today, roughly 70 points, and more than that, rather, from the day's highest point coming in, the 0.3% cut coming in on the Nifty on an intraday basis alone. Sensex also has done very nominally better than Nifty, but nonetheless has faced the market pressure as well, because 0.2% cut coming in on Sensex as well, and it's just hanging above that 78,000 mark on the Sensex Sensex. Advanced decline ratio was evenly distributed today, but it was slightly in the favor of the declines today. Let's pull out the broader markets. Nifty mid-cap, biggest underperformer on the street today, a 1.3% cut coming in on this index alone today. Nifty small cap, however, has not done that bad at all. 0.3% cut coming in, largely in line with what the Nifty was doing. Nifty Bank, however, continues to be the real outperformer. Remember, last couple of trading sessions also, it's been the PSU banks and the banks that have been shining bright. Nifty Bank has once again managed to make a recovery and is back in the green. 0.2% uptick coming in on Nifty Bank today. Sectorally, if you take a look at what did well today, it was day of Pharma through and through today. A bunch of Pharma stocks have done well, followed by IT and Nifty Bank. These are your three indices in the green. Everything else, however, has ended in the red, with Nifty Realty being your biggest loser, followed by Auto, FMCG, Metal, Energy, PSU banks and Media, your most to least sectoral losers. Very quickly, stocks and news today. Swiggy was in focus, Trent on the back of its numbers, REC on the back of its numbers. All of these stocks were in focus today. Swiggy, big cuts coming in 6.3%. Trent was also lower by roughly 6% first when the numbers came. That cut has intensified, 8% fall coming in on Trent. These are some of the stocks that we wish to highlight today, but well, yes, this is how the market construct has looked like, and that's how we have wrapped up today. Even below the 23,650 mark on the Nifty is how we've shut shop for the day.